Are we on the brink of a worldwide economic crisis? With alarming insights from experts, we have crucial updates for you.
Exactly. We'll cover opinions from Chris Whalen about the Federal Reserve and its impact on inflation, plus predictions about whether the oil price collapse spells trouble for OPEC.
Plus, don't miss insights from FX Evolution on market dips and Karsan's take on upcoming volatility.
Stay tuned as we break down the implications of these trends and how to protect your investments amidst uncertainty.
Time to navigate these currents as we dive into today's topic. China's economy is in crisis, and it's affecting markets worldwide.
Here's the scoop. China's bond market is unwinding rapidly amid growing deflationary pressures. What does it mean for the global economy? Buckle up.
What's the core thesis here? What signals are the markets sending?
The main thesis is that China's bond rally is indicative of a serious economic crisis. As bond prices fall, global economic stability is threatened, signaling deepening trouble ahead.
Let's break down the bond market signals. What's standing out?
The 10-year yield dropped to a shocking 2.1%, indicating that the market is losing faith in a recovery. This isn't just a numbers game, it's a reflection of real economic fears.
What's happening globally with commodities?
Prices for critical commodities like copper have been crushed, with the copper-to-gold ratio hitting lows unseen for decades. It signals an impending crisis.
Let's talk about deflation in China. How bad is it?
Reports suggest China's deflation could last until at least 2025, the longest since 1993. It casts dark shadows on growth prospects.
What are the predictions moving forward?
Analysts forecast a continued economic decline. Recovery efforts are likely to fall short, affecting consumers and global markets alike.
And what about other economies? Any ripple effects?
Absolutely. China's economic troubles could lead to heightened deflationary pressures globally, impacting trade and economic stability around the world.
In summary, what should we take away from this?
The crisis in China is serious, with ramifications for global markets. As deflation deepens, all eyes should be on economic indicators moving forward. Stay alert.
And what's next for the global economic landscape?
That's a critical question. How the global community responds to these shifts will be crucial. We'll keep you updated.
Let's dive right into today's market currents. With the recent oil price drop, is this the beginning of the end for OPEC? Joining us for insights is the brilliant Doomberg, head writer at the popular Substack covering energy and geopolitics.
Absolutely. With WTI crude now around $68 a barrel, we're seeing some serious shifts that could redefine the energy landscape. Buckle up for some enlightening discussion on the factors driving these prices down and what it means.
So what are we really saying here about this oil price drop?
Essentially, the thesis is that the ongoing price decline could indicate major challenges ahead for OPEC, especially given the emerging trends toward LNG in places like China and the oversupply in the market.
What's this about China's shift to LNG?
Doomberg highlights that 30% of new trucks sold in April 2023 in China were LNG-powered, potentially reducing diesel demand by up to 800,000 barrels a day. That's a significant shift.
What about OPEC's current strategy?
OPEC is holding back on production despite having the capacity to ramp up. Doomberg suggests their past dominance might be declining, particularly as U.S. shale production ramps up.
How might the upcoming elections play a role?
A Trump administration could lead to a significant increase in drilling, which Doomberg posits would ultimately be bearish for oil prices due to amplified supply.
What's the overall vibe for the future of oil prices?
Doomberg anticipates a downward trend for oil prices in the coming years, alongside increased supply, with potential disruptions from geopolitical tensions providing fluctuations.
And what's the impact of natural gas on the oil market?
Natural gas prices are coming closer to oil prices, potentially driving down oil demand as industries switch to cheaper gas-powered sources.
What does Doomberg predict for OPEC's future?
There's a prediction that OPEC's influence may wane significantly as U.S. shale production expands, leading to a challenging environment for their control over oil prices.
Any other noteworthy predictions?
Volatility is expected to continue in the oil markets, especially as geopolitical tensions rise. However, low prices could hint at broader economic implications.
As we wrap up, what's the overall takeaway from Doomberg's insights?
The energy market is at a critical juncture, with potential shifts away from OPEC dominance and the increasing role of natural gas in global markets. It's an exciting yet murky future.
Any final thoughts on the geopolitical influences?
Absolutely. Geopolitical influences will undoubtedly have a lasting impact on the oil sector, shaping the market landscape in the years to come.
Time to navigate the currents of today's discussion. Did Wall Street just start buying the dip? September is traditionally a roller coaster ride, and our expert sheds light on what may happen in 2024.
Absolutely. With September's volatility, understanding market structures is crucial. This is where analysis becomes your life vest, so hold on tight as we dig deeper.
So what's at stake this month?
The key thesis revolves around September's market actions, signaling either a recession ahead or potential recovery. It's a pivotal moment for traders.
What about market volatility this month?
September is notorious for its wild swings. A significant bounce could indicate a bullish sentiment returning.
And how are inflation estimates shaping the market?
With inflation estimates stable at 2%, traders must be cautious. This data drives market momentum crucially.
Interesting. What's the significance of dark pool activity?
Dark pool transactions indicate large trades that can foreshadow significant market moves. It's a key signal for investor behavior.
What predictions are on the table for late 2024?
There's cautious optimism that markets might recover by late 2024, but it'll depend heavily on inflation and investor sentiment.
So what's our end takeaway?
September's actions are pivotal. Understanding these trends might just prepare traders and investors for what lies ahead.
How important is it to stay cautious?
In trading, healthy skepticism can save investors. Remember, while opportunities abound, risks lurk just as close.
As we wrap things up, what strategies do you think will work best for the upcoming months?
Drop a comment below. Your strategies could influence others navigating this economic storm.
Let's dive right in. Today, we're exploring why the markets are becoming a wild tempest and what it means for savvy investors. Joining us is the expert in volatility, Karsan, founder of Kai Volatility Advisors. Hold on to your life jackets, folks.
Absolutely. Sem discusses a potential shift in market dynamics and the resurgence of volatility. His insights will help us decipher what's ahead and how to navigate these choppy waters.
So what's the fundamental thesis behind this fluctuating market?
Sem argues that we're at the precipice of a major regime change, leading to increased volatility. As we approach important economic milestones, such as upcoming elections, the tide is turning for investors.
Let's break down those key points. What historical context should we be aware of?
Sem emphasizes that low volatility environments often breed excess leverage. When conditions change, investors can experience sharp and unexpected spikes in volatility.
Now, how does the upcoming election factor into this volatility?
As we approach elections, investors are likely to hedge and reposition their portfolios, which can sow the seeds for increased market fluctuations.
What about broader economic structural changes?
Sem highlights how shifts toward deglobalization could impose inflationary pressure. Investors must brace for changing economic conditions.
So, Sem's crystal ball moment. What does he predict for volatility?
He suggests that volatility is here to stay, especially after the elections. Investors should prepare for unpredictability as markets recalibrate.
And what about a possible correction?
A sharp correction may occur if market participants lose confidence due to political or economic pressures. Staying alert is key.
Wrapping it up, what should investors take away from Sem's insights?
The call to action is clear. Adapt strategies. Embrace more diversified and defensive positions as we navigate the stormy seas of volatility that lie ahead.
What long-term effects should we watch for?
Insight into future policies could shape market conditions. Observing how these policies unfold post-election will be critical for investors.
As we conclude, how is everyone preparing for these shifts?
Let us know in the comments. Your strategies could spark a conversation worth having as we brace for the waves ahead.
Time to navigate through these waters. Our next insightful summary dives into Chris Whalen's latest insights on the Federal Reserve's handling of inflation fears. An expert with a wealth of background, Whalen's perspectives could change how you see the markets.
Let's get straight to the facts. Whalen highlights the Fed's hesitance to aggressively combat inflation due to market vulnerabilities. His track record as an investment banker makes him a keen observer of these turbulent financial times. Buckle up.
So, what's at the crux of Chris Whalen's arguments? What are the Fed's current fears?
Whalen suggests that the Fed's reluctance stems from a worry about market stability. While inflation looms at about 5 to 6%, the signs of a recession have yet to crystallize, creating a confusing economic landscape.
Let's dive into the key points. Starting with the Fed's sensitivity to the market, what's the scoop?
Whalen emphasizes that the Fed is overly cautious, ready to make swift interventions at the slightest sign of distress in the markets, often leading them to opt for rate cuts.
And what about current economic indicators?
Despite inflation worries, GDP has climbed to 3% last quarter. However, the narrative is muddied as lending giants have shown low losses, raising questions about recession signals.
A big issue. What's happening with home prices?
Home prices have skyrocketed, making it tough for first-time buyers. Whalen points out a staggering 40% surge recently, raising affordability alarms.
Now, what about predictions? What does Whalen foresee?
Whalen predicts a slower-than-expected recession timeline as market data continues to conflict with traditional indicators of economic downturn.
Interesting shifts on the horizon. What about rate cuts?
Whalen believes that continued market volatility will likely force the Fed to cut rates to maintain stability, driving future economic adjustments.
All right, to wrap it all up, what should we take away?
The key conclusion is that adaptive financial strategies are essential. The Fed's cautious approach highlights the need to keep a close eye on the shifting economic landscape to navigate potential challenges effectively.
What are the potential implications moving forward?
The ramifications of the Fed's tactics are significant. It'll be vital for us to stay informed and engage in discussions around the evolving financial environment. What do you think the Fed should do next? Share your thoughts.
That wraps up our discussion on the pressing insights from several financial experts regarding the state of the economy.
Indeed, Chris Whalen warns that the Fed's inaction could trigger a recession, and Doomberg highlights how falling oil prices might threaten OPEC stability.
It's fascinating how FX evolution points to Wall Street's buying strategies potentially misleading investors, while Karsan emphasizes the rising market volatility.
And let's not forget David Lin's caution about inflation impacting long-term growth. Clearly, a multifaceted approach is necessary.
If you found this video insightful, make sure to like and subscribe. This helps us continue providing you with valuable content and alerts you for future updates.
Thank you for watching. We encourage you to check out our other videos for more expert insights. Until next time.